Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Very nice. How are you doing? How have you been doing, Patrick?
Very, very well. I've been having a great week with a lot of more than nothing. And you?
I feel I could say the same. Feels like a very intense week. Also very exciting. Intense in the all sorts of nice ways.
What
Uh,
makes it exciting?
I mean, I wish I could reveal more on this podcast, but there's lots of very interesting things brewing at Fundamental and our companies.
Oh,
Lots of very exciting things,
God,
actually.
now I wish I knew. But yeah.
Okay, I believe you do, but let's leave it at that.
Okay. We are going to talk today about something that I think is a mix of we've been carrying it with us for the 6 years that we've been building Fundamental.
Mhm.
But there has been an amplification in the interest in this analysis and what it means in the
Mhm.
last 3 months, maybe 6 months, from people around us. And they ask us, hey, what does it mean? Hey, this is amazing. This is an unbelievable perspective. And if it's true, if that comes, it's truly generational. And so we want to talk today about more of this analysis. Some of you might have seen it, but perhaps haven't heard us talk about it. And that is the analysis of what we call the top-down allocators, capital allocators view
Mhm.
on AECS technology. And so we're going to share just two charts. Today, we're going to walk you through that. And we're going to
What?
put
Hang
you.
on. You're saying it's not going to be a 30-slide presentation.
I know.
Yeah.
It's very unusual for us,
Mhm.
but I think the unusual part is to actually have any material at all.
Exactly. That's right.
Um, so we're going to walk you through that, and I think we're going to try to put you into the seat of the people who allocate the big bucks across sectors, across industries, and why that actually matters. So, Shu, before I start sharing the slides here, and we're going to talk, us through it. Any other points we need to set the stage with?
I mean, we get asked often why we think construction tech is the generational investment opportunity for the next VC vintage, or say the next 5 years, 10 years. I mean, I guess we started Fundamental with a hypothesis and a bit of a bet from our side that that was the case. It wasn't always obvious, that, or obvious in terms of the way things were manifesting at the time, that it would play out like that. I would say in the last 6 years, it's very much played out, which is why I think some of the data you'll present, I would say, makes a very strong case for why uh, much of that hypothesis is playing out and coming to fruition.
Right. And have you found that people, when we share this analysis, immediately, um, I don't want to say get it, because
Mhm.
that implies that it's hard to understand, and it's not. But like immediately agree, or have you found sometimes resistance to it?
It depends. So I think with some, as is usually the favorite VC answer, right? It depends.
Yeah, it's interesting.
I think with quite a few folks, it immediately jumps out at them, the obviousness or the starkness of it, as to why there is such a compelling investment opportunity. With a few others, it either leads to a deeper line of questioning, which is fine. And I think we'll be, for those of you listening and watching, we'll be happy to engage with you if you send us your questions and comments and interact with our content. Um, we go down that path. But disclaimer, it is okay. I'm going to borrow something that you have coined, Patrick. It
Oh,
is hidden but obvious,
oh,
what we are going to present. In the
I'm
sense,
not sure I did. It might have been yours.
I think let's say you coined it and I contributed to that. Uh, I think what we are going to present now, it is very simple and very much hidden in plain sight. but it needs a little bit, not a whole lot, but a little bit of second order thinking to figure out why the what we're going to show makes for a compelling case. And sometimes not everyone is interested in doing the second order thinking, if you know what I mean.
Yes.
People want the very obvious, the obvious plus obvious, obvious but obvious situation where there's no need for any explanations.
I'm still looking in my life for the obvious investment opportunities that give me a 10x. If you
Yes.
have one, I'd like to hear it.
Yes.
Yes. Okay, so with that said, let's actually kick the ball over to the charts here. So, Shu, what I actually did, sorry, this is surprising you. What I actually did while you were talking is I actually set a sequence of how we're unfolding this chart. So you're you're literally seeing this for the first time right now.
Hey, I mean, that's just every day as always for us.
I know, I know. And by the way, I'm doing the same to myself here. Um, so what are we looking at? Shub, what we're seeing here is in a very simplified way, we're looking at 6 different sectors that have received a lot of VC funding to fuel technology for underlying markets over the last decade. And we have done the same analysis for other sectors, but the slide is only um, this big. So we're focused on these 6, but the pattern repeats. And so what you see at the top here, Shub, is just the underlying market size. That's
Mhm.
all. Let me walk you with the voiceover here for the folks who don't have currently the chart on their screen. Financial services as an underlying market today has a market size of 23 trillion. Okay, that is large market. Mobility and cars. If you put that together, so the car market and the mobility market is a $5 trillion market.
Just to clarify again, for the benefit of our viewers and listeners, we're talking about global addressable markets here.
Global addressable market. 5 trillion for mobility and cars. 3, tourism and travel. $8 trillion market. Quite unbelievable now that it's
Mhm.
bigger than mobility and cars.
Yeah,
But hey, mankind, man, mankind.
that is right.
Logistics, $10 trillion
Hmm.
market. Property operations, meaning, all the management, all the operations of buildings and real estate, is a $2
Hmm.
trillion
Hmm.
market. And now everybody who loves construction knows that construction right now is a $12 trillion market. So
Hmm.
just summarizing, financial services 23, mobility and cars 5, tourism and travel 8, logistics 10 trillion, property operations 2 trillion,
Hmm.
construction 6 times bigger than property operations, 12 trillion, right?
Yeah.
So that's the market sizes we're dealing with. McKinsey, David Rockhill, buddy of ours, says in 24, and his team says in 2040, the construction market is going to be 22 trillion. So about the same size as financial services today,
Hmm.
right? Now, let's go a step further. If you look at the VC funding that is supposed to help these underlying markets become digital, become automated, become roboticized, become more efficient. If you look at the venture capital funding that went into these sectors, let's start with fintech, which goes into financial services. It took fintech 8 years to get from 5 billion in VC funding to 50 billion in total
Hmm.
VC funding. To be clear, this is not annualized, this is not annual funding. This is total cumulative. So the jump from 5 billion cumulative to 50 billion cumulative took fintech 8 years.
Hmm.
Mobility tech, addressing mobility and cars, 6 years. Travel tech, addressing tourism and travel, 5 years. Logistics tech, addressing logistics, 6 years. Prop tech, addressing property operations mostly, 7 years. So the
Hmm.
pattern is 5 to 8 years. In the median, it really is 6 to 8 years. And this pattern, Shub, has held across all the sectors that we've analyzed. Construction tech, AEC tech, our sector that addresses the construction market, stands at 6 years to 34 billion. So
Hmm.
very, very likely we will keep up with fintech within the 8 years to 50 billion. Is
And
this
of
making
course,
sense?
it is to me, for sure. I think what we're also saying here is there's a very obvious outlier of all these in all these sectors over here. Tell us more, Patrick. Like, why? Which is the outlier here, and why is it such a dramatic outlier?
So to look at the outlier, I need to unpack the chart one more further. So now let's look at how the sectors preceding In
Mhm.
terms of technology and VC funding, construction tech have developed. So fintech, once it had crossed 50 billion after the 8 years,
Mhm.
it ballooned to 490 billion.
Oh, wow.
Okay,
Okay.
that's where it stands. Mobility tech stands at 290 billion, past the 50. Travel tech, 180 billion, past the 50.
Mhm.
Logistics tech, 300 billion, past the 50. Prop tech, 150 billion, past the 50. So if you map this out in terms of accelerating growth, that's what you would see. You would see exponential growth from 5 to 50 and even more exponential from 50 to 490, 290, 180, 300, 150. So construction tech stands at 34,
Mhm.
right? So the question that we asked ourselves 6 years ago, and we've been maintaining this chart ever since, is, what does that tell us in terms of capital allocation in the future? And one of the most powerful views that you can have is, how does this, in terms of timeline, develop? We just said that. And in terms of market share for the underlying market. So
Mhm.
fintech, actually, with the 490 billion cumulative VC funding, stands at only 2% of the financial services market size of 23 trillion.
Mhm.
Mobility tech, 6%. Travel tech, 2%. 2% is 180 billion of 8 trillion. That's the calculation here. So
Mhm.
2%. Logistics tech VC funding has 3% of the logistics tech market. Prop tech stands at 7%. That's the tallest we have here.
Yeah.
You know where construction tech stands, Shub? Tell me.
A tiny, tiny fraction of that, Patrick.
0.2% today.
Mhm.
That's 34 of 12 trillion. And so that's the capital allocators view, right? Is that, hey, if you look at the pattern, if you look at how the timeline has unfolded and how we are keeping the pattern, it doesn't need a rocket scientist to tell us and to tell a capital allocator that we will go from 0.2% to 2 to 3%, which is the lowest we see in all the other markets.
Yeah.
Fintech 2%, travel tech 2%, logistics tech 3%, prop tech 7, mobility 6. It will 10 to 15x to 2 to 3% from here. And that's not even accounting for the underlying market growth that David and
Exactly.
his team at McKinsey are forecasting. So, what do you think of this?
I mean, so this is what, at least I would describe as a generational opportunity. So you're right, it's 10 to 15x in terms of the percentage share of the market. It's about 10 to 15x of the market penetration. If I was to use penetration as the term of the extent of funding uh, as a share of the overall market size. But if you account for the actual amount of dollars in real value terms, when you account for the growth in market, you're talking 20 to 30 times when you account for the growth in the underlying market as well. That's an enormous change, right? So that would be the equivalent of, I mean, how many markets can you talk about where you see a 20 to 30 times potential growth over the next, say, 15 years? And which also, by the way, right now has an addressable market in today's dollar terms of about 12 trillion. That to me screams a very, very obvious and a tremendously exciting investment opportunity.
Exactly. And it doesn't. So what's interesting here from the capital allocators perspective is that, it's exciting to invest in markets that grow from a tiny baseline to a big baseline. But
Mhm.
that growth comes with higher risks than the usual 2 to 3% annual growth that an established incumbent market would have, in terms of the assumptions that you're making for regulation,
Mhm.
for technology growth, for technology adoption, right? So, but this is what capital allocators look for. Here, though, what you're going to invest in is a 10, 15, 20, or 30x on a highly established market and a highly established technology market, and the intersection of the two is what's growing. So you have demand for your technology, and the pattern that holds is that this demand will only increase. Now, we have been asked, Shub, okay, that is a very top down perspective, but what are the underlying reasons why
Mhm.
technology will actually be procured? So, in other words, what is the underlying reason why our sector should repeat the pattern? Like, what do you think?
I mean, I could do what I do every day, take the lazy way out of this, and just tell you, hey, go watch episode 34 of Practical Nerds. Which, by the way, if you as a viewer or listener haven't, I think I highly recommend you check it out. I think that is sort of like a preview to what we're discussing here, and it'll go a long way to help you better understand why all there's so many tailwinds which are structurally irreversible and irresistible, even if I may use that word, which are in favor for construction getting to where it deserves to be. But I'm guessing the lazy way out will not cut it as an answer for this discussion. Um, I think there's a few contributing factors. I mean, mankind is dramatically short of buildings, infrastructure, people, um, but also producing tons of carbon emissions, doing things very, very efficiently. Our productivity is very low and getting worse in construction. And yet the nature of construction is such that it's projectized. There's a lot of specific time and materials component to how the work gets done, and all this is like a perfect storm of opportunities, or perfect storm of crises.
Yeah.
It also doubles up as a perfect storm of opportunities to capitalize on.
I had a founder team today on the phone, and they use the term double crunch to
Mhm.
describe the markets that they are currently looking for to found in. And construction is exactly that. You have a double crunch because the demand is exploding,
Mhm.
right? So we keep saying that 75% of the infrastructure in 2050 isn't even built yet. The floor space across the world net will double. That doesn't even include renovation, brownfield stuff, etc. Asia will double, Africa will double, or more than double actually.
Mhm.
Latin America will more than double. US will almost double. Europe will go up by 70%, 50 to 70%, that is. All of that fueled by population growth, by rising middle classes in many parts of the world, and by migration, right? So that's the one side. We just need to build an insane amount of infrastructure, of manufacturing space, of energy space, of distribution, and of floor space for housing. And on
Mhm.
the other side of the crunch, that's the double crunch, is our supply is just shrinking,
Mhm.
especially if we talk about qualified labor. So
Yeah.
we're going to enter the most ambitious building era of mankind with the least professional and least qualified workforce. That
Yes.
is a double crunch. And so that's exactly why technology purchasing is absolutely survival dependent
Mhm.
for these incumbents in the industry.
And look, I mean, some of you listening to this may say, I hear all this, but you're still talking about things which are perhaps not as much to the surface. Like people like talking about AI and data centers and energy needs. But hey, I hear you, and there is perhaps from a and because we are putting ourselves in the shoes of a capital allocator and an investment case on what might be trending, say in 3 to 5 year horizons. But you know what? This is what I meant by needing to just dig one layer deep, get to a second level thinking. Just pause and reflect, even to uh, really dive right into the tailwinds of data centers, AI. You'll find a lot of them also need construction to kick in simultaneously. A lot of data center work is fueling construction activity.
Yeah.
Go back and I mean, in one of our episodes, we have spoken about a company called Vertiv, which is doing just that, and there's quite a few other companies as well. I mean, recently there's a company. I'm going off on a tangent here, but a company called AirTrunk in Australia,
Hmm.
uh, just a builder of data centers. Phenomenal business. Got valued at I think 16 billion, 15 or 16 billion. Just an 8-year-old company building data centers,
Wow.
right? You can call it a data center company, but I also see it as a builder of data centers, builder of infrastructure, if you will.
Which is
Uh,
exactly what we're needing.
yeah, and if you need alternative sources of energy, a lot of that also is being supported by construction work.
Yeah.
Newer methods of construction or methods of construction tailored to new kinds of assets, new kinds of energy production. So it's not like we're discussing things which are not feeding into uh, urgent needs and very popularly discussed needs as well.
I mean, I love first principles thinking, and you can summarize the construction, the most first principle, the most axiomatic view of The world that is requiring construction is the following. You can't make it more axiomatic.
Mm-hmm.
In our three-dimensional perception of the universe, you have to stack atoms on top
Mm-hmm.
of each other in order to create something,
Mm-hmm.
right? And so until we either leave our three-dimensional perception of the universe into other 22, 24 dimensions, I'm probably not going to see that happen in my lifetime. We're going to have to stack atoms.
Mm.
Okay. Now, how do we stack atoms? So either you're finding some technological true first principles breakthrough, how you can stack and recombine atoms that is non-mechanical, that has not the need of restacking these atoms with a huge amount of energy the way we have it today, then you're abandoning construction the way it is. But until then, you will always have to, in some form of mechanical and thermodynamic way, stack the atoms. And that is construction. That's
Mm.
exactly what it is. And so if we want to build a space economy, we will have to find ways in order to stack atoms under very inhospitable environment and with very poor supply chains.
Yeah.
That is stacking atoms. And we're doing it today on Earth, earthbound. We're going to do it in a space economy, and both will need some form of mechanical or mechanically enabled way of stacking the atoms. And that is the most first principles way of construction. And that's what you will not get a way of unless the other two things that I briefly mentioned happen, probably not in my lifetime.
Yeah. I mean, you ended the sentence on a surprisingly morbid note. So I'll just take it away to a more, I guess, an optimistic tone. I mean, I just again think, so many other large markets. Maybe this is a simplistic view, maybe this is a self serving view. In so many of these other markets, you're basically looking for disruptors or new entrants who can carve out their own position in a market that's already grown to a very sizable scale. And and obviously there is a place for that as well. Overall, I find it a fascinatingly compelling case, and frankly a much easier case to understand when you have a large base and it's growing secularly
Mm-hmm.
and it has reasons to for the growth to accelerate even further. And there's obviously underrepresentation, as we have just discussed, in terms of VC funding. I find that a very compelling triad of reasons. Uh,
I
yeah.
I agree. Now, we promised two charts.
Hmm.
So the second chart that we have here is um, sometimes when we discuss the pattern of top-down capital allocation between VC into underlying markets, sometimes we get asked, hey, but why would top-down capital allocation drive the procurement of technology in the underlying sector? And the answer is it's a flywheel.
Hmm.
More capital drives better talent. You have been seeing this in AECS tech over the last 5 decades, over the last 5 years. So AECS tech is a category that was not born in 2018. In fact, it has been around for at least 15 years prior, if you count the Procore era. But
Hmm.
actually, you and I have been saying, no, sorry, it has been around for 6 decades because
Yeah.
CAD was invented in the 60s and applied to architecture and construction,
Yes.
right? So, and there has been phenomenal talent, but the quantity of phenomenal talent is driven with more capital. We even see it in our portfolio. The DigitalOcean founders IPO'd for 5 billion, went into construction tech. Privalia founders sold their company for 600 million in e-commerce, chose construction tech. Go through just your own directory of founders that you admire in construction tech, and you will see that over the last 5 years, we are at an accelerated growth of high quality talent seeking to choose construction tech as their next endeavor. And that is different to the first 55 years in this abundance. And what that does is when you have more capital and you have more and better talent, the incumbents pay attention because now in a track record industry like ours, they start to believe that these solutions are good enough for them, that
Hmm.
either on the tooling side or even better on the guaranteed outcome side, they can procure with confidence.
Hmm.
And that's then seeding the ground for them also how to procure, how to adopt, how to interact with technology. And so there's a learning curve there. Now, this learning curve then gets perceived by capital allocators. They see it because now the first generation, second generation founders and their startups, they show revenue growth. Not everybody wins, and they are of course more than fail than succeed. But you do see that actually there are these companies that make terrific revenue, terrific market caps, terrific margins, and that's a signal of the customer adoption. Now you talk to customers and you hear all this. What do, Shub? You allocate more capital.
Yeah.
And what happens to the talent? More flex in.
Exactly.
Flocks in. What happens to the adoption? More happens. That's the flywheel that is fueled by top-down capital allocation.
Mm-hmm. And I would say once the flywheel starts moving, you see a very virtuous snowballing of a snowballing effect where the outcomes get bigger and bigger, and the outcomes also get more numerous. And that is where the both the market size as well as the extent of digitization, and as far as we are concerned, the amount of funding and funding interest in the sector dramatically and exponentially goes up.
And that is what has happened in the sectors that we have analyzed preceding construction tech. It is this flywheel that gets propelled by further top-down capital allocation that makes the curve go vertical.
Mm-hmm.
And so that's the inflection point that we at least believe construction tech has surpassed.
Mm-hmm.
And the next inflection point will happen past the 50 billion of total cumulative funding, which in our timeline will happen within the next 18 to 24 months.
Yeah, absolutely.
By the way, I should remark one thing. The 34 billion that we have on this chart here, actually, you could make a case it's 41, because what we're always excluding in our numbers is Catera, View, and Helio, which are three companies that cumulatively, I think, have raised somewhere between 5 to 7 billion. So actually, the true number probably stands at 40 billion right now.
I see. So we're probably at the cusp of breaking the 50 billion number. We're not
exactly.
very far from it at all.
And keeping the pattern.
Exactly. Yeah.
Yeah. So quick one today, Shub, short and sweet, but we felt it was good, perhaps walking folks through step by step what we mean with this capital allocators view.
And also a good refresher for why we're doing what we're doing at Fundamental.
Yeah. I mean, I like it. In my opinion, it's the most exciting generational investment opportunity of the next 2 to 3 decades.
I couldn't agree more, which also surprisingly is what I used to say when we used to do a podcast called Disagreed.
Yeah, that one was not very on brand, I have to say.
Yes.
Yeah. All right, our little ritual here. What's in your calendar next week that you're looking forward to?
So I'll repeat what I've been saying for the last 2-3 weeks, which is, I think, generally not a bad thing in this case. Quite a bit more activity happening in general in the ecosystem. So quite a few of our portfolio companies are also benefiting and participating with follow-on rounds, etc. So a lot of that is keeping me occupied. Also involved in quite a few intense discussions, very much around the capital allocation theme. And I guess we leave it at that and not go more in details on what that means.
Nice. Okay, on my end, I'm meeting with a founder team that has been building software for the supply chains in and around construction. Been in touch with them for 2.5 years. Looking forward to hearing from them. How's it going? Because I do think, and I repeat myself a lot here, you optimize construction sites through the supply chains.
Absolutely. And if I'm not mistaken, that one very much fits the outcome as a service description.
I would say so.
Yeah. Nice.
Yeah. All right, sir. Happy weekend.
Happy weekend, sir.